Imagine you're the CEO of a company you've built for 10 years. You've saved capital, refined your strategy, and protected your assets. You're finally profitable. Then, you decide to bring on a co-founder. You sign a contract giving this person full access to the company bank account, 50% ownership of everything you've built, and 50% of everything you will ever build. You also agree that if they leave for any reason, they can take half the cash, half the intellectual property, and you might have to pay them for years after they're gone. You don't run a background check. You don't look at their financial history. You don't even read the contract carefully. You just sign because you have a good feeling. If you did this in business, you would be fired. Your board would call you reckless. Investors would laugh you out of the room. But millions of people do this every single year. We just don't call it a merger, we call it marriage. Welcome to the Financial Sketchpad, where we draw out the hidden math behind everyday life decisions. Most people think marriage is about love. And emotionally, it is. But legally, marriage is something else entirely. It's a financial contract, a legal merger of two economic entities. When you say I do, you trigger tax laws, property laws, debt liability rules, and asset-splitting statutes that bind your financial future to another person's behavior. Yet most people spend more time researching a phone upgrade than they spend understanding this contract. They walk in guided by emotion, completely ignoring the balance sheet. And that's dangerous. Because financial incompatibility quietly destroys more wealth than market crashes ever will. Let's talk about the most common failure mode, marrying a spender. This doesn't look like a disaster. It looks like a slow leak. Let's say you're disciplined. You save $20,000 a year. Over 30 years at 8% growth, that becomes more than $2 million. You're on track. Now you marry someone who doesn't have a problem. They just like nice things. Better vacations, leasing new cars, eating out most days, being generous with gifts. Nothing extreme. Just an extra $15,000 a year in spending. Your household savings drop from $20,000 to $5,000. Run the math. Saving $5,000 a year for 30 years gets you about $500,000. That difference? $1.5 million. You didn't lose that money in a divorce. You lost it because consumption quietly suffocated compounding. You were filling a bucket, and someone else was drilling holes in the bottom. Over time, the psychological cost sets in. You become the no person. Every money conversation turns into friction. Eventually, you stop fighting. Not because you're wrong, but because excellence has too much resistance. Now let's talk about the faster version. Divorce. First marriages fail roughly 40 to 50% of the time. Second and third marriages fail even more often. That's a coin flip. Imagine an investment with a 50% chance of modest growth and a 50% chance of instantly losing half your capital. No rational investor would touch that. Yet we take this bet with our entire lives. When divorce happens, the math turns brutal. One household becomes two. Overhead doubles. Efficiency disappears. Then the assets get split. A $500,000 net worth becomes $250,000 overnight. Then come the transaction costs. Lawyers, realtor fees, taxes, forced liquidations. By the time the dust settles, 60 to 70% of your purchasing power is gone. And now you're starting over older, exhausted, with less time left to compound. Divorce doesn't just split assets, it creates long-term liabilities. Alimony and child support can legally require one person to fund the lifestyle of the other for years. Think about that. Even though the partnership failed, the financial obligation remains. I've seen high earners making six figures living close to poverty, not because they don't earn, but because they don't keep what they earn. Add hidden debt, financial infidelity, or a destroyed credit score, and suddenly your balance sheet isn't yours anymore. You are legally tied to someone else's financial behavior. So how do you reduce the risk of this massive decision? First, radical financial transparency. Before engagement, open the books. Credit scores, debt, spending habits, beliefs about money. These aren't awkward conversations, they are essential ones. Second, the prenup. Not because you plan to fail, but because risk exists. A prenup is insurance. It forces clarity while emotions are calm. It defines expectations. It protects both partners. Refusing to even discuss one is a red flag. Here's the good news. When done right, marriage is the most powerful wealth-building tool available. Two aligned partners, shared values, a controlled lifestyle, and compounding working together. That's not just romance. That's leverage. The goal isn't to avoid marriage. The goal is to avoid a bad merger. Choosing a spouse is an asset allocation decision. You are allocating your time, your emotion, and your future earnings to a single position. Pick a partner who compounds you, not one who discounts you. Because broken hearts heal. But broken retirement accounts last forever. If this helped you think more clearly about money and relationships, hit subscribe and give this video a thumbs up. I'll see you in the next sketch.